Well, from a quantitative point of view, it's generally meant that there's been, FX as an asset class has not had the same interest as perhaps it would have done in a different market regime of higher vol or what have you. So there's definitely less interest in FX as an asset class. But that also presents opportunities. So in that lower vol environment, you have to perhaps look at other strategies that do still perform, and that might be harvesting volatility risk premium in a low vol environment. It can still give you, generate good returns.
So our members as wholesale market brokers or IDBs have been affected particularly by the low volatility in the G5 currencies, where volumes have shifted to electronic platforms from voice, and definitely the volumes in the derivative side, i.e. the FX options, have decreased as the appetite for optionality has gone down, although we have seen that reverse through the summer with the moves in the euro and the yen. However, all year our members have reported record earnings in the NDF currency pairs, particularly China and the Southeast Asians, but also those in Latin America as well. And we've noted that a lot of the Latin American execution flow has been moving out of America back to the locus of its home countries, or even to Europe, with the impact of the DoddFrank obligations effectively segregating the US person community from the non-US person international community who are involved in the FX markets.
Well, obviously the regulators are quite concerned about anything that will affect the markets, but they need the data, they need to understand what the impact will be, and ultimately they'll adjust the fine-tuning of the rules to suit what they think the overall economy needs.
Of course, our customer, ACD runs 3 business models. We have to make alpha out of the money that the investors giving to us. That was not easy when the volatility was low, so our performance was low and poor, so nearly flat to nothing. We haven't taken a lot of risk. We couldn't sell volatility because it didn't make any sense to do that at that level. And we couldn't buy the volatility because it didn't make sense. So we were somehow blocked as well. And we also, the volume on the execution side, where we add clients on their trading style, the clients have not done a lot. The volume broke down, not only in banks, also at ACT. So the only thing you could do is do as much as you can. You have to cut down your costs. You have to survive even when you have increased the costs on the compliance side. But this is the game of the entrepreneurs, and you have to manage that. And it's sometimes easy and sometimes it's less. It's hard work.
Well, volatility is a nightmare for traders. No movement, no money. It's as simple as that. As I say, they're not door numbers, but at the moment they've seemed like door numbers, with central banks really very much controlling the agenda. But we're just seeing signs maybe that we may well be seeing that moving a little bit more in our favour.